Think you know how the economy works? Chances are some of what you know is actually a myth. From ideas about job creation and taxes to misconceptions about inflation and debt, many economic beliefs are misleading, yet we keep repeating them. Today, we're busting the most common economic myths you still believe and showing you the real story behind the numbers. By the end, you'll never look at the economy the same way again. Today, we will talk about common economic myths you still believe. So before we start, make sure to hit the like button and subscribe to my channel. Economics is often seen as a dry, abstract subject filled with graphs, percentages, and complicated models. Yet, the economy affects every aspect of our daily lives, from the price of groceries to the jobs we hold and the taxes we pay. Despite its pervasive impact, there are many misconceptions about how economic systems function. These myths are not only widespread, but also stubbornly persistent, shaping public opinion, influencing policy debates, and even affecting personal financial decisions. Understanding these myths is crucial because basing decisions on false assumptions can lead to poor financial choices, misguided policies, and even societal inefficiencies. One of the most common economic myths is the belief that higher taxes always hinder economic growth. While it's true that excessively high taxes can discourage investment and work effort, the relationship between taxation and growth is not linear or simple. Countries like Sweden and Denmark maintain high tax rates, yet enjoy strong economic growth, robust social safety nets, and high living standards. The key lies in how governments use tax revenue. Efficient allocation toward infrastructure, education, and health can actually boost productivity and long-term growth. On the other hand, low taxes combined with inefficient spending can starve vital sectors, limiting economic potential. Therefore, assuming all taxes are inherently bad oversimplifies a nuanced issue. Another pervasive myth is that government debt is inherently harmful and always leads to economic collapse. While excessive debt can create problems, moderate debt is a standard tool in economic management. Governments often borrow to invest in growth-promoting projects such as transportation, technology, or education, which can generate future revenue exceeding the cost of borrowing. For instance, Japan has high public debt relative to its GDP, yet it remains one of the world's largest economies with strong infrastructure and a high standard of living. Debt only becomes problematic if it reaches unsustainable levels or is mismanaged, leading to inflation or loss of investor confidence. Thus, the blanket idea that debt is bad is misleading. Many people also believe that trickle-down economics reliably benefits everyone. This theory suggests that tax breaks or incentives for the wealthy will stimulate investment, create jobs, and eventually trickle down to benefit lower-income households. However, decades of economic studies have shown that the benefits often concentrate at the top, increasing wealth inequality without guaranteeing broader economic gains. While business investment does matter for growth, the assumption that benefits automatically flow to everyone is overly simplistic. Effective economic policies often require targeted investments in education, healthcare, and infrastructure to genuinely empower the broader population. The notion that minimum wage increases always destroy jobs is another enduring myth. Critics argue that raising the minimum wage forces businesses to cut employees or reduce hours. Yet numerous empirical studies show that moderate increases in minimum wage rarely cause significant job losses. In fact, raising wages can stimulate local economies by boosting the purchasing power of low-income workers, increasing demand for goods and services. The key is balance. Sudden, extreme increases may strain some businesses, but thoughtful adjustments in line with inflation and productivity often benefit both workers and the economy. A related misconception is the idea that inflation is always bad and must be avoided at all costs. While hyperinflation, where prices rise uncontrollably, is harmful, moderate inflation is often a sign of a healthy, growing economy. Central banks typically target low, steady inflation to encourage spending and investment, rather than hoarding cash. Inflation also allows for wage growth, reduces the real burden of debt, and provides flexibility for monetary policy. Therefore, fearing any inflation can lead to counterproductive policies like excessive austerity, which may slow economic growth and increase unemployment. Many people also misunderstand the nature of unemployment statistics. It is often assumed that official unemployment rates reflect the true health of the labor market. However, these figures usually omit discouraged workers who have stopped looking for jobs and underemployed individuals who work part-time but want full-time employment. Additionally, some people believe unemployment is solely a result of laziness or lack of effort, ignoring structural factors like technological changes, globalization, and skills mismatches. Misinterpreting unemployment data can lead to misguided policy decisions, such as focusing excessively on incentives for job seeking rather than investing in education and retraining programs. Another myth revolves around the belief that trade deficits are inherently harmful. Many assume that importing more than exporting signals weakness. In reality, trade deficits often reflect strong domestic demand, investment inflows, or global supply chain dynamics. A country running a trade deficit can still have a thriving economy if it attracts foreign investment, has a strong currency, and maintains high productivity. Conversely, a trade surplus does not automatically indicate prosperity, as it could reflect underconsumption or suppress domestic demand. Understanding the context behind trade figures is essential before labeling them as good or bad. Finally, the myth that money grows on tricks or shortcuts like stock speculation or crypto hype continues to captivate many. The allure of quick wealth often overshadows fundamental economic principles like saving, investment, and risk management. While high-risk investments can yield rewards, they also carry significant chances of loss. Sound financial practices, diversifying investments, understanding market trends, and long-term planning remain the most reliable path to wealth accumulation. Believing that markets are simple or predictable can lead to catastrophic financial decisions, reinforcing the importance of economic literacy. In conclusion, economic myths persist because they simplify complex realities, offering seemingly intuitive explanations for intricate phenomena. However, these simplifications can distort policy debates, mislead individuals, and even impact national prosperity. By critically examining assumptions about taxes, debt, trade, wages, inflation, and financial markets, we can better navigate the economic landscape. Understanding the truth behind these myths empowers individuals to make informed financial decisions, allows policymakers to craft effective strategies, and helps society as a whole avoid the pitfalls of misguided economic thinking. Dispelling these myths is not just an intellectual exercise. It is essential for fostering a more prosperous, equitable, and resilient economy. If you liked this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.